Brad Williams, Frugal Finance. Let's talk about equity market sectors. This information by FINRA. I used to be registered with FINRA long ago, just FYI. What are we talking about here? Market sectors. You might know if the stock market is going up or down, but do you know what industry sectors are driving returns? The use of sectors is one of the most common ways to characterize markets, and the most used system is the Global Industry Classification System. Created in 1999 by investment providers MSCI, that's Morgan Stanley Commodity Index, and S&P Dow Jones Indices. GICS divides every publicly traded company into 11 sectors and then further divides them into industry groups, industries, and sub-industries according to their principal business activity. GICS was designed to standardize industry definitions and to enable accurate comparisons. These classifications can be used in the design of funds, including mutual funds and exchange-traded funds. You're going to find that the deeper you get into stock analysis, we use the term industry averages. What does that mean? Well, here is a perfect example. They have 11 industries, but you want to break that down into sub-industries, and then you want to do a comparison. So, for example, if you're looking at pharmaceutical stocks and you like a particular company, Eli Lilly, for example, how do they compare to industry averages? Are they above industry averages? Let's say there's 22 related companies in that sector. That's one way of doing a comparison, relative value. You're going to look at the pricing of those particular stocks and see how they correlate to one another. It's a means of measuring whether they are priced high or priced low. If they're priced low relative to the industry average, is that a good sign or bad sign? That's where you have to look in and turn over a few more rocks and determine, is the risk short term? In other words, did the company have a hiccup? And you recognize that it's only a hiccup, it's short term. I'm going to buy that company because I think it'll at least meet or beat industry averages. Again, you're going to need to practice. You're going to have to understand what that means. Go to my playlist and do a search in terms of, say, relative value or undervalued, or pricing, or intrinsic value, or industry standards, or industry averages. So it's a matter of understanding the different industry and the sub-industries. Funds that focus on specific sectors or industries can be passively managed, meaning they seek to replicate the allocation and returns of a certain index, or actively managed, meaning that the fund manager may pursue strategies intended to outperform an index. For example, the S&P 500. Well, that's a pretty well-designated, well-diversified portfolio, and you don't have to do anything. It's within itself its own product. So there's really no means to do anything other than buy the S&P 500 if you just want a basket of goods. Now, if you're a money manager, you're going, well, the S&P on average has earned about 12%, but I'm really good at what I do. And on average, I've been earning a annual return of 25% or greater. Well, that's where they're going to go through and look at these industries and do a comparison. And correlation is one of the factors used in the industry to see how one industry compares to the other. Then they're going to use a whole bunch of different tools to try to outperform the S&P, since that's the granddaddy. That is, everyone else compares based on how the S&P does. In addition to helping investors compare companies or funds versus a benchmark, GICS provides a standardized description of industries. How classifications can help investors. GICs break down thousands of global stocks into their primary business categories. There's over 40,000 publicly traded stocks around the world. There's about 13,000 in the US. Okay, I can't remember the number. It may be a little bit higher. I'd have to break open my reporting. I think there's 13,000. We want to break this down into sectors. So we look at communications, we got consumer discretionary, consumer staples, financials, energy, healthcare, industrials, information technology, materials, real estate, and utilities. That is a broad categorization. What I look at, there's about 42 industries. What I look at are sub-industries. It would just be too hard to try to get a relative industry average if you used every consumer staples or every financials, because there's a subcategory within financials. That's what you need to do. How hard is it to do that? There's a lot of screening tools out there. You just need to know what the industries are and their sub-industries, and then maybe their sub-industries. And then if it's US only, or if you're doing it globally, or if you're doing it regionally. So it takes a lot of work. That's why analysts are paid a lot of money. Spend a lot of money, they spend a lot of time, and they have endless source of information. They'll use something like Capital IQ, which is just a powerful, powerful tool that you and I don't have access to because it is very, very, very expensive. It's about $40,000 a year for this subscription. Then Bloomberg, they're a great resource. They're very expensive. That's why analysts have a huge leap ahead of average investor because of the information they have available. No, you can't go to Yahoo Finance to get this information. It's money well spent. Now, you can siphon through and this is time consuming, but you can go through and read the 10 Qs, the annual reports and the quarterly reports of the stocks in a particular sector. Then you have to weed through that information, but that's what analysts do. In addition to their access to real-time data, they also will look at the SEC information and parse that and try to find a competitive advantage. For example, there are two consumer categories. Consumer staples includes companies such as food retailers, pharmacies, tobacco companies, and household product manufacturers. That's why I said there's 11 up here, but there's subcategories. While consumer discretionary covers business ranging from hotels to restaurants to media companies and online retailers. Automotive stocks, including electric vehicle makers, are also included in the consumer discretionary sector. You can think about these two sectors in terms of their differences between need to have, like groceries, and nice to have, like vacations, discretionary and non-discretionary expenses. Certain sectors benefit from strengthening business cycles, and while others are considered defensive and might be immune to economic fluctuation. Using GICS classifications, you can gauge an industry or a company's performance more easily by comparing it to that of its peers within a given group, rather than comparing companies at random. While it's easy enough to know that a bank is in the business of finance, for example, is a company that sells services online a technology company or retailer? And is an online payment app company a finance or technology firm? As more companies cross industry lines, it's hard to determine what to compare them to, as that's how GIC sectors classifications can help. To keep up with these changing dynamics, MSCI and S&P conduct annual reviews of the GICS structure. These reviews have led to several reclassifications over the years, as well as introduction of new subsectors. Your prospectus or annual report will show the sectors that your mutual fund or ETF is invested in and how much is allocated towards each sector. Depending on your fund's investment criteria, you may be invested in just one sector or across many. As you research investments, you might also see a SIC code on the various reports or disclosures a company sends to the SEC. SIC stands for Standard Industrial Classification as Coding System, used by SEC staff to indicate which office is responsible for reviewing a company's filings. All right, here is some data that I collect. This information is free. You're going to go to Oswald Damodaran's website. And first, you're going to thank him because he provides this information for free. This is a list of every publicly traded company in the world. There's 41,219. And this information is listed. Here we have industry group. And you can see, we can go down and we have beverages, electrical, building, financial services, power, telecom, food processing, oil, and on, and on, and on, and on, and on, and on. And I could break this down. I'm not going to. But you can see how broad it is. Why? Because if you're going to do a comparison, you need to do a comparison that's related, okay? As I said in the GICS, it's broad. The information here, I think this is from Capital IQ, they break it down much narrower. And in terms of what I look at when I'm doing my particular analysis, is this information. And it just goes on and on. So I'm going to look at broad groups. This is the broad group. Emerging are these growth, the country. Here's your SIC code. And then you have your primary sectors. So here's your consumer staples. This would be your GICS code. And then you have your industry groups. This is how much it's breaking down. Then we're going to look at, this is just some of the stuff that's available. So we've got betas and levered betas. An ERP for countries, that's your risk premium. Your cost of equity, default spreads plus company, pre-tax cost of debt, after-tax cost of debt. This is all information I use when I'm valuing a company. Then we get into the cost of capital, return on equity minus the cost of equity, return on invested capital minus cost of capital, market cap, present value of leases, total debt without operating leases, total debt including leases. This is what analysts do. This is why they're paid the big money, because they understand what all this stuff is. If you don't know what this is, you're competing against a rather strong defense. In other words, these companies pay hundreds of millions of dollars for the top analysts. So you're going to look at this information, and it's used in one way or another. Jensen's Alpha. This is a great measuring tool if you understand what Jensen Alpha is. Beta, you got to know what beta is. Correlation, standard deviation. If you don't know what this is, then dig a little deeper. Interest coverage ratio. That's huge. That's a debt measure. We have current PE. All right, in terms of PEs, there are just endless number of PEs. You have PEG ratios, price to book value, price to sales, EV to EBIT, EV to EBITDA, EV to invested capital, EV to sales. And what we do here is we'll do regression analysis with this information in order to get a determination as to whether these are overpriced, whether they're within industry standards. So what you'll do is you'll take the average of a particular sector, you'll run a regression, and then you'll determine whether the company, in terms of relative value, whether it's a buy or a sell or a hold. Dividend yields, historical growth. I mean, it goes on and 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 on. This information, again, is available if you know how to navigate the Motorin's website. Here you go. And I use about 70% of this information, and a lot of it is redundant. And then Demoterin goes in and he does a lot of his own changes here. Here you go. I thought I'd just throw this little freebie and then be sure to thank him. I went off a little bit of a tangent, but in order to get an idea of what you're against when you think you know what you're doing and then what the pros are doing. Comment, let me know what you think. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.